Hi, it's John Kelly. In this module, we are going to discuss Rule 204 of the Code of Professional Conduct. And Rule 204 is mostly about prohibitions. It's a long rule, so I'm going to do it in two parts. And as always, we want to follow professional standards, be efficient and effective, and document what we have done properly. Now, this rule is about threats and safeguards. And threats that have no safeguards are effectively prohibitions. The people that developed these rules have decided that it's a threat, it's so significant, no safeguards can deal with it, so therefore you basically can't do it. And one of the difficulties I see in practice is people treating prohibitions as threats and saying, okay, the rules say I can't do this, how do I get around it? And that's just a bad idea. The other thing I see people doing is treating threats as prohibitions. In other words, there is an independence threat. There are available safeguards. We should consider those safeguards because most of the time the safeguards will satisfactorily deal with the threats. So for instance, one of the things I see people doing is there are rules on partner rotation, and they decide in a very small firm with no real significant threat to rotate the partners all the time, and that's probably a bad idea. 204.1 is about independence. Member firm and members of the firm, everyone is to be independent for audits, reviews, and specified audit procedures. So just remember, if I ever say you have to be independent in an audit, it's audits, reviews, specified audit procedures. 204.2 just says follow the next two rules. 204.3, we are to identify threats. And if other than insignificant, which we can just ignore, we would then apply safeguards. And if the safeguards aren't enough, we either cannot accept the assignment or we need to resign. And the other thing is you can't read the rules in isolation because different rules correlate or interact with other rules. So you've got to read all the rules together, and there are interpretations of the rules, and you have to read those as well to fully understand it. Financial interest. You cannot be on the team if you or your immediate family has a direct or material indirect financial interest. And there is an exemption for credit unions and co-ops where you have to have a share, but it's a $5 share. So if you're in that circumstance, read and follow the rule. And there are a number of definitions of family. There is immediate family. That's your spouse and your dependents. So that's a small group of people in immediate family. Close family member is a parent, child, or sibling. And for Rule 209(1)B only, there's a definition of family member because you can borrow from a family member, so there is a longer list of people you can borrow from. So for instance, that definition includes grandparents and aunts and uncles, and it would be difficult if that definition applied to things that affected your independence, and that's not what it means. It's about who you can borrow from. So you can borrow from your grandfather, that's okay. 204.4, restrictions are on a member and the firm and their investments. If a partner has a restricted investment, they can't be in the same office as the lead engagement partner. So you can have in a very big firm some partners with some restricted investments, but they would have to be in an office that wasn't particularly involved with the audit. And there are some exemptions, and if you're in a big firm, you got to go read the rules. Small firm, it's pretty simple. You probably just are going to restrict all members of the firm, all investments. And for greater certainty, a member with a financial interest cannot provide non-assurance services. Same for immediate family. And the same rule applies if there is indirect ownership. So you can't audit a subsidiary if you own shares of the parent. Gifts. If you acquire a financial interest by gift or inheritance, and there's some definition about that, you've got 30 days to sell it. Be best if you sold it sooner, but got to be sold within 30 days or you're off the audit team. And what happens if a close family member has an interest and you might not know? You might not know what your siblings own. So is that a threat, and what are the safeguards? Read the rule, of course. A safeguard is discussing that with the audit committee, that you happen to know your brother has 10 shares of the large public company, but you don't think that's a threat. And if you do think it's a threat, you'd be removed from the team. 10 to 12, and there was no paragraph 7 and 9. Loans and guarantees, if you want a loan or a guarantee, the same rules apply all over again. They are independent threats. Now, there is an exemption for loans on normal commercial terms and loans that are in good standing. Best, I suppose, not to borrow from a client. Read the rule. It's a complicated rule. Close business relationship applies to the same rules. So if you are in a close business relationship with a client, even though you don't necessarily own any shares, the same independence rules apply. And I guess the message here is make your money by being an accountant, not by being in business with your clients. And the other caution here is care with buying goods and services from clients. It's difficult both ways. If you don't buy, your client sells a certain product or service and you don't buy from a client, that can be a problem. The client says, how come you're not buying from us? Or on the other hand, if you do buy stuff from a client and it turns out to be defective in some way, are you going to be able to go and complain to the client? Simplest to be careful not to particularly buy stuff from clients. Read the rule. And you can't be on the team if your immediate family is an officer or director of a client or in a position of significant influence. And I sometimes wonder about how you would know about certain of these things. In this situation, if you're doing an audit or review, you should know who the officers or directors or people in positions of significant influence are. And if they're part of your immediate family, spouse or dependents, well, probably not a dependent, it's probably only about your spouse. So you should know whether your spouse is an officer or director of a client, and then you can't be on the team. And you can't be on the team of a reporting issuer if immediate or close family has an accounting role. There are complex rules and safeguards. I'm just going to assume that in a small firm, this is just not applicable. But if you're in a big firm, it's a complicated rule. Read the rule, follow the rule. Employment with a public company. There's a 1-year cooling off period. So if you are a partner in charge of an audit and you go get a financial related significant job with a public company, your firm has to resign. They can't do the audit for a year. And so what sometimes happens is the partner goes and takes a non-significant job with the client for a year and then moves into the more significant job. Again, read the rule. It's a complicated rule. A senior client employee who joins the firm cannot be on the audit team of the client he just left for a year. And temporary staff loans to a client may be okay. There need to be safeguards because, again, as auditor, we're not supposed to be making decisions or taking responsibility for stuff that our client has done, because we're then supposed to audit it and decide whether those are well taken decisions or not. And you can't be an officer or director of a client, period. That includes clients of network firms. There are some minor exemptions, but you just can't. And it's a foolish idea. I see people trying to do it, becoming informal directors. Big mistake, and when you eventually get caught, you're going to wish you'd never done it. Long association, this is a complicated rule. If you have been audit partner or engagement quality control review partner or a key audit partner, you've got 7 years, and then you have to rotate off. And you may no longer be involved with that client. There's a 5-year cooling off period before you can come back, but you've got to leave. Now, the rule includes a technical partner, in other words, a partner in national office that you consult for what the rules are on some complicated accounting matter. It also excludes the annual QC partner. So if the public company is selected as part of the annual quality control review process, it doesn't apply to that partner. And of course, you could have a problem that you've been involved with a client for 15 years and then they go public. There are some exemptions where you have a short period of time where you can continue to be audit partner on that client after they've gone public, and then you have to rotate off. Now, for public companies, it's a rule, and there's no way around the rule. It just has to be done. Now, if you talk to academics who've read the research into whether or not this is a good idea, they will tell you that rotating an audit partner off a job is a really bad idea for independence, because research shows that most of the errors in audits occur in the first 2 or 3 years. So rotation sort of guarantees that the audit partner is for a significant period of time in those first 2 or 3 years, because you're gone after 7. So rotation certainly produces ignorance. You don't know anything about the client. You're coming in cold. People question whether or not it produces independence. And there are a lot of people that would question whether or not replacing the audit partner every 7 years weakens the audit partner position, because you become kind of disposable. And if you do something the firm or the client doesn't like, well, you could just find yourself rotated off. The other thing I see firms doing is establishing an executive relationship partner who is in the role, the senior important role that the audit partner used to be in, of managing and the client relationship. What used to be, when you got to be the audit partner on a significant firm client, it was a significant and important responsibility, and you had that responsibility for the remainder of your career. And you didn't want to do anything that would mess that up in the next 20 years. So if the client was trying to do something now that was going to blow up in a year or two, you were really motivated to make sure they didn't do that, because when the problem blew up, you were still going to be the partner and you're going to be held responsible for it. So some people also wonder whether the executive relationship partner further again weakens the audit partner position. In a non-public company, there are safeguards, which are actually pretty simple and automatic. Discussing with the audit committee, making sure that the audit committee knows you've been in charge of the audit for a long time, okay? The audit committee or the board. If the firm is subject to practice inspection, that is a safeguard. And basically all firms are subject to practice inspection. So those two safeguards are automatic, and I guess my recommendation would be that you would do those or apply those safeguards first and not rotate audit partners unless there was a good reason. Public companies, you cannot provide other services, in other words, other than the audit or the review, without the audit committee approval. But you can with approval. And there are some exceptions, but read the rule, and more particularly if you plan on providing a service to your client other than the audit service, get approval, which, if you think about it, if you're planning on sending someone a bill for a service, it would be a really good idea to get them to agree to the service and agree to the fee before you start doing it. Otherwise, you could get into trouble afterwards. So to some extent, this is only good sense, but it's a rule. Make sure you follow it. And for any entity, you don't want to do management functions. You can't and you don't want to. So there's no authorizing of transactions, no exercising of authority, no picking of recommended actions, no acting in a management role, and ditto if it's a client of a network firm. And again, you want to make your money being an accountant, being independent, not by acting as management and taking on that responsibility, which I don't think we want to take on in the first place. And if you do take it on, it's kind of hard then to do an audit or review when you've made the decision on the transaction and you can't independently decide whether or not the transaction is appropriate or not. Use of the word preparing. We cannot prepare journal entries. And of course, we have to make journal entries because we've found what we consider to be a material misstatement, and a journal entry is needed to fix it. And the client's not going to get a clean audit opinion or a clean review engagement report if they don't make the journal entry. But we can't call it preparing. We have to call it proposing. This is kind of language and terminology, but never use the word prepare with respect to anything. Always use the word propose, and management, of course, needs to approve the journal entry you have proposed. I would suggest in every representation letter there be a sentence that says, "We have approved the journal entries you have proposed," and we'll record them. So never use the word prepare. Eliminate it from your vocabulary and replace it in all circumstances with the word propose. We cannot prepare source documents, and source documents do not include, so we can prepare them, trial balances, reconciliations, and aged listings. And often we're going to be doing that as part of an audit or review. Now, this is an interesting linguistic differentiation. There are documents that precede source documents. So we're not allowed to prepare source documents, but it's okay if we help with documents that precede source documents. And so some of those things would be a bonus calculation for tax purposes. The client doesn't quite understand how to do the math for income tax, asks us to help do the bonus calculation. So we might do that calculation, propose it to the client would approve it, and then the client would prepare the source document, which would be the declaration for the minutes that this was going to be the bonus. We might help with an impairment test. We might prepare sample wording to be approved by our lawyer. So if there is a bonus to be declared, we might draft the minutes, for example, send them to a lawyer and say, "Hey, we've drafted these minutes. You should look them over, fix them if you think they should be fixed, and get them in the minute book." So those are things we can help with. They're not source documents. We need to carefully read paragraph 6 in the advice paragraphs after 204.424. It says that very clearly an audit involves extensive interaction with the client, and that management may request advice, and they're going to have to take our advice if they want a clean audit opinion, but there's a lot of back and forth and discussion, and here's my math and here's your math. I'll tell you a story about a client of mine. I guess I was the second partner, and the client had done, a public company client, and they'd done an earnings per share calculation. And it was a complicated calculation because they'd issued a bunch of shares and redeemed some shares and this and that and the other. So it was a complicated calculation. And the audit partner came to me and said, "I think they've done this wrong," which of course is the first thing you should do. If you think something's wrong, you should go talk to someone else. So we put our heads together and read the rules and redid the math and sent it off to the client and said, "Hey, we think you've done the earnings per share calculation wrong. We think it should be done this way." And the client wrote back the next day and went, "Ha, ha, ha. Yes, I agree. You're right. I did it completely wrong. But you did it wrong too. And here's the right way." And the audit partner and I looked at it and went, you know what? He's right. That is finally the right way. So going back and forth with a client, here's the client's math. No, we disagree. Here's our math. No, I disagree. Here's my math. And coming to a conclusion that we're both happy with in the end is the way an audit's supposed to work. And the client has to approve it in the end. The client has to say, yeah, I agree. You're completely right. That's the right way of doing the math. So that's important as well. So it is okay for us to assist a non-public client with assisting in reconciling accounts, assisting in accumulation for regulatory reporting. So for instance, for a non-public client, we can help with tax slips. We can't prepare them, but we can help. Subtle difference. We can assist with the consolidated financial statements. So the client says, well, here I've done the consolidation. I've added the parent and the sub numbers together. And we would then go, oh, well, you forgot to eliminate intercompany sales and you forgot to eliminate intercompany transactions. And we would assist. We would assist with drafting disclosure. The client might say, well, here's the disclosure, same as last year. And we would go, oh, perhaps you didn't know, but here's an additional piece of disclosure that's required this year. Would you like us to help with that? Sure. We can propose adjusting journal entries. We can assist with subsidiaries. So if we're sending a bill for doing the consolidation, here's our bill for preparing the consolidated financial statements, probably would be better if we said, here's our bill for assisting with the preparation of the consolidated financial statements. Safeguards. Client is to prepare the source data, of course. And again, in the representation letter, you might have a sentence where the client says, we have prepared the relevant source data. And if you get into something really complex, discuss it with someone else, just like the story about the calculation of earnings per share. Discuss it with someone else. Make sure you're right. So read, understand, and follow the rules. Got to read them all. Got to read them all together. I think most of the rules are obvious. I guess in some cases, partner rotation, maybe some people think that's a good idea. Maybe some people think that's a bad idea, but we don't care. It's a rule. We're going to follow it. And as I said, trying to find a way around the rules is just generally a bad idea. So thanks for listening.